You're listening to It's Only Money with financial advisors Scott Brown and Tammy of Edgewater Family Wealth. EdgewaterFamilyWealth.com, of course, is the website where you can get links to past shows, blogs, financial talks, all that kind of fun stuff. And it's all free at Edgewater Family Wealth, plus the contact information to get a hold of Scott as well. And it is a weekend, and we're here with you. Good morning, Scott. Good morning, Tammy.
Good morning. Happy weekend.
And I hope you're all having a happy weekend out there. I'm sure people come to this show and they're like, hey, I think everything's collapsing. Banks are falling apart. It's 2008 all over again. What do we do? And Scott, obviously you're going to tell me that it's time to buy all the ammunition to fight the zombies and get my 5-gallon buckets of mac and cheese from the big box store. And any other advice you have for me because there's obviously everything is falling apart.
Yep, bunker supplies. I think that's critical.
Okay.
Yeah. I mean, I think the critical part when things are not going well is to panic. I think if you panic, that just helps. There isn't a situation out there that panic doesn't help. Am I correct on this?
100%. No, I don't think so.
That's wrong. That's bad logic.
I think so. I think the panic, correct me if I'm wrong here, but panic, like if you're having a bank run and panic, you're now having bank runs that wouldn't have bank runs, right. And then it becomes this feedback loop of awful that didn't even have to happen in the first place.
Well, it's fire in a crowded theater, right? It's somebody screams fire, and it's a self-fulfilling prophecy. Everybody gets hurt, and this is, this Silicon Valley Bank, SVB, as we're all now calling it, has suddenly become a prominent topic of conversation for obvious reasons. First of all, it's just the media loves a good catastrophe. So let's dig right in with our fork and spoon and get after it. So what happened here is that there was no fraud. There was no bad person twiddling running their fingers together and what do we say, spinning their mustache.
With the mustache.
Twirling their mustache. There was no twirling mustache in this crowd, as far as I know. What happened was they made some bad investments that backfired on them, and by bad I mean treasuries. So you say, well, how is it possible that a bank could buy treasuries and that's problematic? It sounds very conservative to me. Good for that bank. And the problem is not the treasuries themselves, but the liquidity of those treasuries. So what happened was Silicon Valley Bank, as the name would imply, is a large bank for many of the VC and private equity folks out in California that create companies like Google and Amazon and Uber, and a lot of the money that they have is kept in these banks. The problem was, as interest rates rose, the availability of funds for these firms to continue to do business became scarce, and they didn't really want to spend 7 or 8% to get capital that they used to pay 2 or 3% for, right? So they started retrieving their liquidity that they kept with SVB at a very rapid rate. And then once other private equity and other VC saw that this was happening, most notably Peter Thiel, who is one of the PayPal mafia folks, famous for a variety of things, but in this case, he's famous for kind of ringing the alarm. And once he went on Twitter and said, hey, this bank's struggling, well, guess what? He basically threw gasoline on the fire, in my opinion, and caused a run on the bank. Now, the good news or bad news, depending on who you are, is that depositors look like they're going to be okay. At this point, the Treasury and the administration and members of Congress, of course, will argue and point fingers in the meantime. But at some point, they're going to back the depositors, from what I understand. The bank itself is in shambles. The equities evaporated. The ownership of that bank and management of that bank, their options are going to expire worthless. The bondholders are not going to be made whole for the most part. So there was, capitalism at play, creative destruction at play. Now we could have a very lengthy debate, and I think a healthy debate about depositors, right? We all know the rules, right? Ryan, do you know the rules for banking? When you put money in the bank, how much is typically covered by FDIC?
$250,000.
There you go. So most people know that per registration is $250,000. We all know that's the rules when we put money in banks. Yes.
Yeah.
Well, those are the rules, but we ain't following the rules, right? So there's many institutions in this case that had literally 50, 60, 80, $100 million in this bank that apparently those deposits are, at least best we can tell, are going to be made whole. So, on one hand, I say good, these are companies, venture company, they have employees, they have expenses, they need to meet payroll. That's probably a good thing, right? If you're looking at it from that side of the political spectrum, is this isn't just these companies that it's going to hurt, but it's going to hurt all these employees of these VCs and private equities at various stages of growth. That's one way to look at it. The other way to look at it is a completely snaggletooth capitalist, right? Where you say, well, that's moral hazard, right? And for those of you who don't remember moral hazard from your economic textbooks, that's what happens when you tell people these are the rules, but then when things don't go well, when it's capitalism on the way up, as Scott Galloway likes to say, hand-to-hand combat, the best survive, survival of the fittest. If you're good at it, great. If you're not, go away. That's what we say, right?
Mm-hmm.
But then in the end, when things fall apart and the government comes in and backs up whoever screwed up, that creates what we call moral hazard, which is basically teaching a population that you don't have to investigate your bank. You don't have to know if they're solvent. You don't have to know. In this case, it was an overconcentration of one type of depositor, right? These big private equity and venture capital people were all concentrated in this bank for good reason. This bank had a great track record. It had been involved in many deals that we now know as common household names, right? These are all wonderful things, but the problem was that concentration of depositor when they all needed the money at the same time, and even if they didn't need it, went after their dough at the same time, it caused a run on the bank. So again, you could look at this from many different angles. The primary two, I think, are if we're capitalists, are we through and through capitalists? Are we capitalists with no stops, free market?
Mm-hmm.
First of all, I think that ship sailed a long time ago, right? We've backed up the banks in the S&L crisis. We backed up the banks in 2008, right, during the Great Recession. There are many, many examples where government has stepped in to provide a backstop. So the argument could be, have we created a culture where now when somebody puts money in a bank or starts a bank or makes an investment or gets a little too far out over their skis, like it doesn't matter? Right.
But that's socialism.
I believe that is an element of socialism. So that goes back to what kind of economy do we have? And I would argue we haven't had pure unfettered capitalism for over 100 years, right? We do support certain things. We do have social safety nets. And I'm not arguing against any of these things. My point is it's not cut and dry. So you're going to have people on one side of the political spectrum pointing fingers saying this happened because the blue people passed this legislation 3 years ago or 7 years ago. And then on the other side, the blue people are going to say, well, the red people deregulated. And this is, well, you're going to overregulate now. And that's just going to squash the economy. We're going to have to hear this for the next probably 3 or 4 months till something else bad happens that makes this go away in our minds, right? So the first thing I think people need to know is this is probably not going to be contagious throughout the system. This is an isolated incident. It did lead to a couple other banks that are overexposed in similar ways to kind of get the attention of regulators, and they're being held in receivership. But this is entirely different. Some people are saying, well, what's the connection between Credit Suisse and the issues they're having as a large Swiss bank? Yes.
Mm-hmm.
And to this bank. And actually, it's just a coincidence. Credit Suisse, for my best recollection over the last decade or so, I have been hearing about this bank for years having questionable analytics, being a little bit less than solid as compared to, say, a Bank of America or a Chase or Goldman Sachs or whoever it is. So, and the last thing I will say is that if we do create a situation where we don't backstop regional banks or we don't backstop local banks, we have many of them here in our community, right? If we don't do that, the argument that could be made, I'm not making it, but could be made, is that people will only put their money in the big banks, in the five biggies or Goldman and Citi and Bank of America and things like that. People will only put their money there because they know they're too big to fail, right? That's the whole concept. And we're actually seeing deposits running to those banks right this second, because people are flipped out about the idea that these regional banks won't be backstopped. So clearly that's not been the case so far. But again, to put a bow on this ugly mess, is that there are a lot of ways you can look at that. And as politicians, each politician's going to stake their claim to some ideological higher ground. But the reality is everybody's had a hand in this, from the over-regulators to the under-regulators, right? So, they're going to look to point fingers quickly, lest the finger be pointed at them. But I think for the average investor out there, what they really can hang their hat on is I don't think this is throughout the system. We actually have a pretty solid banking system, especially as compared to many. But it's not perfect, and it's not going to be without pitfalls. I don't care how much you regulate or don't regulate. Every decade or so, somebody's going to make a mess of it because they're going to find a little loophole or do something they shouldn't quite do. And in this case, there was nothing nefarious. It was just bad timing and bad luck, and that's part of the game.
That is part of the game. And I feel better now knowing that explanation. See, and all of this is free. You get this on the radio for free. And you can also go to Edgewater Family Wealth to get more in-depth knowledge, from financial talks to the blogs to the past episodes and the information to get a hold of Scott at edgewaterfamilywealth.com is the website. We'll be back with more It's Only Money here on the radio. Welcome back to It's Only Money, and I'm here with financial advisors Tammy and Scott Brown of Edgewater Family Wealth. EdgewaterFamilyWealth.com is the website you want to go to for all the information, including how to get a hold of these gentlemen. And it's the second segment of the show. It's a beautiful weekend day, and I got bad news, Tammy.
What is the bad news?
Well, normally, Tammy's our guy. He's our numbers guy. This guy is a whiz when it comes to the numbers, and he's got his own theme song that goes along with it. But currently, my system is down, and I cannot play the numbers song.
I got this.
Yeah?
Are you ready? I've been saving this. I think this is critical.
Oh, really?
Yeah. Just hang in there, everybody.
We got a backup.
I'm
All
holding
right.
my breath. It has numbers.
All right, those are numbers.
That's a throwback to all my friends who remember Schoolhouse Rock.
Schoolhouse Rock.
That makes me all nostalgic and wants me to eat a big giant bowl of Lucky Charms.
Was that three's the magic number?
3 is the magic number.
That is a catchy song. Now, I wasn't around for the original Schoolhouse Rock, but they came out with they redid the music for it and had contemporary artists of the 90s make them. And
so it was a grunge version?
I believe the one that did Three's the Magic Number was Blind Melon.
Nice.
And it's a great rendition of that song.
I love Blind Melon. I'm going to definitely check that out.
Yeah, it's good. It's a whole album of various 90s artists redoing Schoolhouse Rock.
Did Nirvana do Conjunction Junction? What happened?
That's a good one.
They did not. No, unfortunately. And I'm Just a Bill was the one on there. Remember that one? Yeah, check that out. But that's not what we're about here. We're about the real numbers.
Real numbers.
Solid numbers from we got to come up with a nickname for it, Tammy, it's hard. Nope. Something with name. We'll get there. We'll find it.
We can have people send in ideas.
Yeah.
For Tammy's numbers nickname.
Yes.
That'd be great. Yeah.
How are the numbers, Tammy?
Well, the numbers says hello, apparently, because the yield now, with all what we saw last week, how the market moved, we saw the yield for the risk-free yield dropping down in a way that we haven't seen in many years.
Oh, the Treasury.
The Treasury.
1-year Treasury.
Yes.
Yeah.
Because we talked about this before. It is the benchmark we use to see what rate return that we can get without, exposing ourselves to much risk.
It's basically our risk-free benchmark.
It is.
Yeah.
And that's the U.S. Treasury yields across different durations. We have from 1 month to 30 years, basically. And
now, for an average listener, low good, low bad.
Well, to make it simple here, no, the higher return you get, the better it is, right? That's simple. And that's what the Fed tries to do whenever they want to get the cash out of the market. We talked about that. They've been, in the past 2 years, they've been trying to get that cycle in, and we've been in that cycle to create an incentive for investors to invest in fixed income instead of equity. That's one. Also, to slow down the economy a little bit, to combat inflation.
Well, and what led to that drop last week was the banking.
Yes.
Largely the banking issue and a flight to quality, right? So when money's moving into an asset classes, it reduces the value of that asset class. You no longer need to give a higher rate of return because the money's already flowing that way, right? It's really supply and demand. And what Tammy's referring to is that drop from 5 to 4 was unprecedented as quickly as it happened.
Yeah.
And as investors fleed a variety of asset classes to hide for a minute, because of course we all overreact and panic when we probably shouldn't. And to that end, what did we see in the financial sector in terms of returns since the SVB announcement?
It's about negative 12%.
Yeah. So people are fleeing those kinds of
They
stocks. At least that's part of the equation, and they're heading to the Treasury. Now, historically, that has not been a good idea. When there's danger, people want to hide and they wait till there's no longer any danger. But at that point, we'll probably see that the financial sector has recovered before they get back in. So banks on the whole, I know the first day, the banking sector was down about 3.5% just that one day alone. Again, and if you're holding a bunch of bank stocks, you're kind of like, ooh, that's smarts. But I think if you knee jerk out after this thing's cratered 5, 6, 7, 8, 9, 10%, it's likely you're making a mistake long term.
Well, isn't that what SVB did? They went full Treasury. Like it seems like they. So you always say the Treasury bonds are like they're safe because they're backed up, and I know it was a thing they were trying to get liquid and things like that. But isn't always the best case scenario to be diversified in general? Like, is being 100% into bond is bad?
Well, it was only bad because of the duration. So they were in 3-year treasuries from my understanding. I'm certainly not an expert, but what I've read and heard is that they were in mostly 3-year treasuries that were all paying, in the 1s and 2s, not the most liquid asset class. In other words, they paid $100 for those bonds, right? And let's say they're halfway through the duration of those bonds. They're in year 1.5, right? And then suddenly everybody wants their money back, right? And they go, oh, well, we're going to have to sell these treasuries. Well, they can't get $100 a bond until they mature. So they're discounted because rates are much higher than the 1.5 in my pretend scenario that they're getting. So they might have only got 80 cents on the dollar or 75 cents on the dollar because they were forced to sell at a bad time. The other way these banks make money is to loan it, right? They pay money and they give money, right? So if I gave them $100,000 and they said they're going to pay me 2%, and then they turn around and loan it to you at 5%, that's how another way banks make. That's largely the way banks make money, right? This treasury thing is more of a liquidity crunch. It's not that they didn't have the assets; it was that they had to sell them at a discount, which hurt their overall numbers, which is the reason that the feds came in. It's just a bad scenario. Tammy and I were talking earlier about what triggered it, which explain how that got triggered how we got to where we are.
Well, initially, Moody's, the crediting agency, they informed SVB that they're going to downgrade them a couple of levels, not one level, a couple of them. So SVB wanted to prevent that, and they said, well, we're going to sell a bunch of assets that we hold in the balance sheet to raise capital. And that way we can cover the debt ratio in order for Moody's not to do that.
They were going to issue equity, if I'm not mistaken.
There were a bunch of them. There's in accounting, banks have something called ready to sale assets, and that was part of it. They also were going to sell preferred shares.
Yes.
And a bunch of other, let's say, accounting stuff.
Gimmicks.
Well,
and so what happened there was in an attempt to fend off the ratings agencies, and I could spend a whole hour complaining about them, but to fend them off so they didn't get downgraded, they said, well, we're going to raise more capital. When they said they were going to raise more capital, that got the attention of some of their depositors who were like, well, why do they need to raise capital? And then rumors spread, and then high-profile individuals run their mouths, and then things kind of went downhill from there.
Is there not like insider trading that applies to banking like this? Because this does seem like it's a lot of rumors. People knew certain things ahead of time, and Thiel got his money out fast.
Yeah, probably. I don't know that for sure, but my assumption is he got a bunch out. If he had much in there, I don't know, but probably. But yeah, it's really not insider trading. It's more, to me, it's almost like yelling fire in a crowded theater, right? What is the regulation that's being broken there? Probably legitimately isn't one. Does that mean he should have done that? Probably shouldn't have, but he's a bit of a wackadoo to begin with, so I'm not going to speak to that guy.
Now, you said something earlier, just before I forget this thought, which is like you said, people don't look enough into their banks. Because you just haven't tried. For me, my takeaway from this is, this entire system is just built on trust,
pretty much,
and which is kind of an amorphous concept. But how would one check into their bank if you are using a small bank?
Well, I mean, and again, I say that as really I'm referring to institutions. As individuals, I mean, for better or worse, the average American doesn't have more than $250,000 in a bank. That's sad but true. Good news, bad news, right? Good news is your entire deposit is FDIC insured. Bad news is you wish you had more that they couldn't insure it, right? So I mean, that's a thing. I think what I'm referring to more is understanding the stability of a bank, what they keep in reserves, and that's more of an institutional thing. Like, I don't expect the average person to be digging through the accounting records of Chase Manhattan, right? Or Goldman Sachs, because their heads would probably explode, as would mine, to be honest. So what I'm saying is, institutionally, if you're a VC or a private equity firm, though, and your whole existence is based on being able to do accounting and financials, it would seem to me you could take a second to figure out the financials and accounting in a bank where you're about to deposit $50 or $100 million. And again, this is where we could have an all-day argument back and forth and debate, never really come up with an absolute as to how much support the government should give depositors and to what level.
My favorite thing is, like, when I see like a bank that closes down and you're like, how did you do that? You are literally made of money. You are doing this wrong. It's like when I see like a gas station close down, I'm like, they bring you gas, you sell gas, end of thing.
Yeah, it seems simple.
It seems so easy. I've got it all figured out, Scott. I don't, but these guys do. And if you want to get a hold of them, go to edgewaterfamilywealth.com for anything, whatever you need. You guys deal with tax stuff, I know that, retirement planning, things like that. And if you just want to get one thing off your plate and put it on to experts, Edgewater Family Wealth is the place to go. We'll be back with more It's Only Money. Welcome back to It's Only Money. It's Only Money is brought to you by Edgewater Family Wealth. EdgewaterFamilyWealth.com is the website. There you get the financial talks, the blogs, and the information to get a hold of Scott and Tammy and plan your financial future with Edgewater Family Wealth. All right, we've gone over the banks. We've done the thing.
We've done enough banking.
Enough banking.
Although you did say something funny, because if you asked your parents for money, what would they say? I'm not made out of money.
Yeah.
But to your point, banks are literally made out of money.
Yeah.
Right. That seems like that shouldn't be a problem. But apparently it is every decade or so.
It can be.
Yeah.
They seem to be good with their money because they're not letting you just take their pens. They're attached to things. Like, it's not like they're just giving out
steal
stuff.
The pen. And I mean, most bankers wear that dark suit and have the monocle, right? Isn't that what most bankers look like?
That's what mine are, definitely. Yeah. And I say, can you pull up my account and show me my balance? And they just laugh, and I guess how much my balance is based on how hard they're laughing.
Right.
Yes, as they twiddle their fingers.
But you should. I think the motto here, or the moral of the story, is: do not trust a banker without a monocle.
Right.
Like that's a hard pass for me. If you come out and you don't have a monocle, I'm going on to the next bank.
Absolutely. In fact, I'm going to open up Monocle's Monocle's third bank.
Supply and demand. Yes.
Do you know the answer to this? Well, tangent. Like, there's banks like Fifth Third Bank.
Mm-hmm.
And like First National Bank, Second National Bank.
Mm-hmm.
Why
would you want to be Second National?
Right. And then the one bank's pulling in fractions, and I'm like, I don't think they know when they were started.
Yeah, like, when was that again? Were we fifth? Were we third? Maybe we're fourth.
Yeah, I figure like once they're like, we're First National Bank, and you're like, I want to start a bank. Oh, there's already one here. They're the first. I'm going to go to the next town.
Yeah, to be the first.
Right.
Because you don't want to be second.
Yeah, and I'm not doing my banking at Seventh National Bank.
No, definitely not Seventh National. Yeah, I cut it off at 3 or 4. I cut it off at Fifth Third.
Yeah. Those are fun numbers. Yeah, Tammy's got the serious numbers.
Well, we said 3 is the magical number. Right?
Yeah,
we did.
As per,
we have 1, 2, and 3.
Schoolhouse Rock says so. All right, well, let's try to get back to something important here. So we're talking about numbers and treasuries, and so what else do you have for us that's relevant to something other than the banking numbers?
Other than banking numbers. So past 3 days, we had few economic data releases. We had the inflation numbers, CPI, and we had the retail sales and the producer price index. They're all connected.
Yep.
We can talk about that later, but The good news is that the CPI now, the CPI headline is down to 6% from its peak back in June when it was about 9%.
Yeah. So we're making progress, albeit slowly.
Yeah, it's snail.
Yeah.
Moving there, but it is doing that. To push that now, the narrative and retail sales index that we see, that retail sales basically monitors how much people are going out there and shopping. That also pushes inflation up. And we saw from previous numbers that although we're having those interest rates going up, and we said that credit card rates are up, everything else is up, yet the shopping was the same. And that wasn't because of savings, it was because of people's exactly.
We're increasing the credit card debt.
So
we're Americans. We're not going to stop shopping just because we don't have money.
Well, maybe
it'll be ridiculous.
Maybe we will. Maybe
no, we're not going
to have some optimism.
That is not how that works. I know you're a new citizen, Tammy, but let me explain to you how it works here. We shop whether we got money or we don't got money.
Yeah, we're not letting something silly like finances stop us.
Come on.
Well, numbers mean nothing.
That's right. No, you don't feel bad. Your numbers mean something to us. So go ahead. Now we made him sad.
So shopping is down now. We have the retail sales down about 0.4%. That's also good. Well, the producer price index that measures the cost to producers when they produce any good out there.
Yeah.
And that let's say that gets there before CPI. So how much does it cost to produce an item, not how much the item is being sold for? So that's another indication of
I have
inflation.
a specific question for you.
Yeah.
The new home window index, is that way up? Because according to my builder, it's way up.
New home.
Because I'm building a new home and my windows are just astronaut through the roof. Pun intended. I mean, the reality, just every time I look at the bill, it's like they haven't shown up yet, by the way. So I'm building a house, for those of you who don't know that, and the windows were supposed to be delivered like 4 weeks ago. And first of all, the price went way up from the original cost, right? And then so the day they were supposed to show up, I get a phone call, they're not showing up. I guess you know what they always say, right? Supply chain. Right.
I thought that was 2021.
I don't know. That seems like an old excuse, but that's what they're going with, right? And so they don't show up. So literally the morning they're supposed to be delivered, they call me and say they're not going to be there because we don't have the paint to paint your windows. So my first thought is, well, they're literally supposed to be here now. So were you going to paint the windows on the truck en route to my house? Was that the plan? Right. And then so they were supposed to show up again this week. Guess what? Not showing up. Yeah, so that's apparently the supply chain in Windows is completely gunked up. So I don't know if that's in your numbers anywhere, but I would like for you to call whoever's in charge of that index and get things moving. Anyway, I digress.
The Windows supply chain is surprisingly opaque.
Oh, we could do this all day. These dad jokes we got lots of them.
I'll call the Windows people.
Yes, please do.
I hear it's a real pain.
Oh, I feel like there's a Bill Gates joke in there too. Anyway, continue on with the numbers, Tammy. We've gotten way off course here.
Oh, my Windows.
Yeah.
Oh my God. So basically, and that's I think all I have. I don't have the Windows, but I took a note down there to get the Windows.
Yeah. So
number.
let's go back to inflation real quick. Because I threw you off with the whole.
Yeah, where are we at
thing.
on various curves? I know there's one type of curve that you always got to watch out if it's if it's pivoting
inverted,
or whatever it does.
Inverted is the word.
Inverted. There we go.
Like Tom Cruise, it's inverted.
Yeah.
Now, one of them now reverted.
Whoa.
Reverted.
Whoa.
We can't say that word anymore.
Yeah. Oh my goodness, we're in so much trouble with this boy.
So
go ahead.
There's the 10-year to the 30-year curve there. That in March, that was the last one that was not inverted by then.
Yeah.
But then it went back to normal just after what happened last week.
Normal, it reverted back to normal.
Reverted back, meaning you get more return for longer term.
Yeah, well, I mean, I think the takeaway there is inflation slowly coming under control, we hope. It seems to be the trend anyway, and I'm sure it's not fast enough for a lot of people. But that's good news, because what that means is at some point we hope, and this bank thing is actually in this stew as well, maybe the Fed will rethink its aggressive rate increases in an effort to tighten. And if it does that, there is a lot of evidence or a lot of theory that says if they stop tightening or threaten to stop tightening, that we'll see both the stock and the bond market react very favorably. And in fact, there's a hint of that now with what you described, which is the 1-year Treasury dropping by 100 basis points in no time.
Yep.
Which lent itself to a pretty favorable print on the bond market today.
Mhm.
And I haven't looked at the equity markets. I think they were kind of flat, but I think we will see a Fed slow down in the tightening schedule. And if they slow down in the tightening schedule, we'll probably have a pretty impressive quarter that follows that in the stock market. And that lends itself to this. Be patient, because a lot of people are getting tired. What happens here is capitulation. Investors tend to get about this point in the cycle and give up, because they're like, all right, well, last year was tough. I'm not going through another year like that, right? I don't want to. Well, you will if you need to, right? Because most people give up right before the bottom is put in. In fact, I have some clients that I write down. If they call me and tell me to get out, I know the bottom's in. So I won't tell you their names, but I know they know who they are. So now is not the time to capitulate. Just be patient. If you have good quality companies, stocks, especially fixed income, you're just going to have to hang in there. I've been looking back at a lot of accounts, and if you look back over the last 20, 25 years of some of my account holders, they've got, in 25 years, they've got 4 negative years. Maybe some of them have 5, depending on what they owned. But again, you're talking about 1 or 2 years out of every 5 or 6 years, you're going to have a bad year. And as I said a million times, absent the bad years, you don't get the good years. And when you add the bad years to the good years and you do an average, your number is still historically in the S&P 500, 7 or 8% a year. So if you get goofy, if you get scared and you're tempted to get out, turn off the TV and go for a walk.
See, that's where I feel like I have the advantage, because I started most of my investing during a bad year. So I have no idea what it's like to be good.
Exactly. You're welcome.
But for me, it's like I keep putting money into this system and it just keeps going down. I'm like, woohoo!
This is working well.
Yeah.
I won't pay any taxes at this rate.
Exactly.
It's a tax savings program.
So I'm investing my future. The day when it does go up, I look at it and it'll blow my mind, because I'm just so used to this. But don't be like me, I guess. But they're like my mother-in-law. She's that though. She's like, oh man, this year's really hitting me, and I'm like, you haven't retired yet.
Yeah.
So
and people with 401ks now, that statistically, if you compare 401k, we'll call it shuffling. If people shuffle around their 401ks when they get nervous, if you look at the down cycle in 2008, we saw a pretty mass movement. People got pretty freaked out. They moved out of stocks. They moved into fixed accounts, a variety of things. We're not seeing that at the same level in 401ks, because I think investors are more educated this time around. They understand the due diligence and the discipline. So when we come back, we can talk certainly more about that.
Yeah, don't panic. Put your financial life into the hands of Edgewater Family Wealth. They're the people that are doing it. Tammy's looking at those numbers every day. Scott is constantly going over this stuff. And if you're out there 401k shuffling, you don't have to do that. Talk with Edgewater Family Wealth. EdgewaterFamilyWealth.com is the website, and we'll be back with more It's Only Money here on the radio. Welcome back to It's Only Money here on your radio and or podcast, and or maybe you're just perusing EdgewaterFamilyWealth.com and listen to this as a past episode, because that's where we keep the past episodes as well, plus financial talks and all kinds of things like that. But most important is the information to get a hold of Scott and Tammy and secure your financial future, and keep calm and Edgewater Family Wealth on.
Yeah, we secure your final future.
I guess there's only one future. So
that's the funeral home, actually.
And this is the only time that, like lately, I've had to stop. Okay, so I stopped myself from looking at my investing apps, my Fidelities, my Robinhoods,
my dopamine hit.
Right, because it got to be too sad after a certain point.
It made your prefrontal cortex feel good.
Yeah, and honestly, like when I started, I was like in that last bit of the incline of the market going well. So I'm picking stocks and they're going green, and I'm like, I am a genius.
Clearly.
And now a lot of red on the board, Scott. And how I was picking stocks is questionable now.
Tell me about when you sit down into your process, you probably I'm picturing you got a whiteboard and probably a scientific calculator, and you're probably poring over charts. You have a big giant desk that you have literally the charts and the earnings per share and the earnings to book, the earnings to sales. You're probably looking at management, looking back at their history. You're probably figuring out, is this a value stock or a growth stock? What are the earnings of this company? What new products are coming out? You're probably doing all these things, aren't you, Ryan?
No. What I did was Ford has a new cool truck coming out. They're probably going to sell a lot of it. I'm gonna buy some Ford stock.
Is that how the voice in your head sounds? I'm gonna buy some Ford stock.
I'm gonna buy some Ford stock. They're an American company. They've been around for a long time. Cruise ships are doing bad financially right now. They're going down. This is real. Going down. But then I saw a thing about Carnival Cruise Line, and technically they have this war chest of billions of dollars that they just sit on, and they have more than any other cruise company. And I'm like, well, all these other cruise companies will probably fail. Carnival can last this COVID thing out for a while. Their stock's crazy low. I'm going to buy it. It's only going to go up when vacation time kicks back in. Did not work out.
Well, I got to give him credit because there was one actual piece of credible, accountable financial, which was their war chest of cash. At least he had the wherewithal to say these people got some cash.
Yeah.
Right?
Cash is good.
Most people do not invest that way. Most people invest through a rear view mirror. Most people invest because they heard somebody else is invested in a stock and they don't want to be left out.
Right.
My brother-in-law bought some Coke or some Tesla or some whatever. And if that dumbass is buying it, I don't want him to outpace me, even though they forgot the first part where they called him a dumbass. But they ignored that part and say, I don't want to be left out, so I'm going to buy Coke and Tesla, right? That's how or they read in the newspaper, which this is hilarious to me. Reading in the newspaper along with, if you're reading the Journal or you're reading Barron's, not that these aren't good things to read, I read them, but if you're saying I'm ahead of the curve because I read about this company, Pfizer or Merck or Micron or whatever company it is,
Virgin Galactic,
them in particular, as I read about this company in a newspaper article, are you under the false impression you're the only one reading this article? And by the way, the reporter that wrote that got that information from somebody who had it 3 months ago. So again, the way we invest is just nonsensical. We put so much time into so many things. I got, my motorcycle buddies. They will investigate a handlebar setup or the grips on their handlebars for months, and this is made out of silicone and it flexes, and this one's heated, and this one feels great on my left hand but not great on my right hand, and if I'm going to clutch, how does it fit? And they'll go on for days telling me about the grips on the handlebars of their motorcycle. But if you ask them how they pick stocks, I don't know, I like the name.
I'm laughing because it's so true. I spent a year figuring out PC parts, really going into it, watching half an hour long YouTube videos about whether to get an AMD CPU or an Intel one. And and I picked Virgin Galactic because I saw just
very cool logo.
Rich guy goes to space.
Yes. Richard Branson, he seems fun.
Yeah.
Yes, that is how, how else do you account for people buying GameStop?
Yeah.
Right. What?
Well, that one felt fun. To be fair, that one felt fun, and it felt like an us versus them kind of situation.
But it had game in the name.
Yes, and at one
fair.
point it made a lot of money and then lost it all.
Yes. There's been, there's people, there's a couple of stories out there in a few texts that talk about people buying the wrong stock by accident. Like they hear a name and then they buy the symbol they think is associated with that. And then they do really well by accident.
That happened to me. Yeah. Shout out to GLNCY. I don't know what that is. I was trying to buy.
Works better if you randomly pick stocks where you just whip a dart at a page, because people invest the absolute wrong way. We know that things are cyclical. We know that companies revert to the mean. That's how capitalism works. If a company's really good at something and they have the market, cornered and they're making a ton of profit, what's going to happen? Other people are going to go, I want to get in that business, which is going to eventually erode their profitability. That's how capitalism works. But as investors, we say that'll never happen. Nobody will ever challenge Amazon. Nobody will ever challenge Tesla. Well, look out, Tesla. because Rivian's out there, Nicola's out there, Ford is producing Lightnings, Chevy's got a new whatever. It's their profitability, which P.S. they don't have any for to speak of, is being eroded, right? They're being challenged. So, but what we do as Americans is we look at the thing that's up the most because it was the most profitable or the most sexy, and we buy that, which is why I would argue you'd be better off whipping a dart at the stock page than trusting your very, very bad instincts.
That's so funny. I'm so mad at this. So I did do that, and that the stock that I told you about wasn't the one. That was one of my smart ones because I was like, okay, where's the world going? They're going to need lithium for batteries and stuff. I'm going to invest directly in the people that mine this kind of stuff.
Sure.
And that one crushed it. Clovis Oncology, though, I own because I was trying to buy another meme stock and put in the wrong one. And because I think so it's true, though. But so how do you pick a stock then? Do you even engage in day trading, or are you just all investing? And is it you looking at the handlebars of the motorcycle?
We are testing out the grips on the handlebars to some degree, but so first of all, you need to think about terminology. If you're buying a stock saying to yourself, how will I buy it and how will I sell it? You're not investing, you're trading. And I'm not pushing one way or the other on trading, although I would say it largely doesn't work for most people. What I am saying is that that's a different mentality. So what we do, Tammy and I, or Tammy does a lot of the hard part, is we evaluate stocks. We say, all right, well, what is our criteria for buying not stocks, but companies, right? Warren Buffett's famous for saying his favorite holding period is forever. I'm not quite there, but I'm pretty close to there. So, the reality is I'm looking for a value. I want a good company at a fair price. Buffett says I want what does he say? I want a wonderful company at a fair price, right? And some people say I want a fair company at a wonderful price. Either way, we're looking for a deal. We're looking to say, you know what? The banking would be a perfect example. The banking sector is down on average, what'd you tell me, 12%?
12%.
All of those companies aren't going out. In fact, most of them are not going away. Some of them are gigantic, huge banks that aren't ever going to go away and are blue chip companies that pay a nice dividend. They are literally on sale right now. This is, by the way, for the lawyers out there, I'm not saying go out and buy bank stocks. What I am saying is most of those companies will be here 10 years from now, and you will look back at this moment and say, well, I could have got a 12% discount on XYZ Bank, right? And I liked XYZ Bank, but it was down, so I didn't buy it because that makes sense, right? Of course it doesn't make sense. So if you're in the banking, if you like bank stocks right now, you should be looking through the rubble and saying, okay, here's 10 banks. Yeah, this one's kind of questionable. It's somewhere in North Dakota, and I'm not quite sure what they do. But here's a big regional bank that's got, billions of dollars in reserves, pays a nice dividend, and is down 15%. Maybe, just maybe, I ought to think about buying this one rather than waiting for that bank stock to come back up 20% and going, oh, I guess they're good now. Right? You just gave up a big portion of your potential gain. So when we're looking for a stock, we're really looking for a company. We're looking to say, are they dominant in their industry? Do they have plenty of cash on hand? What's their book to sales? What's their book to cash flow? There's a variety of measures that we like to talk about. We don't like to stay in too much in one sector. We like to diversify in that way. But really, we're just looking for great companies with good multiples and an opportunity to make more.
Wow, that was a very concise answer that I think most people can understand, because it's, a lot of people look at it like, I'm going to buy based on the line. They're like, and they're like, this stock it's down now here, and they don't know what it is.
Right.
Whereas your approach is, let's look into the company.
Yep.
Let's make sure they're solid and they're doing what they're supposed to be doing. The CEO is not a psychopath, and make sure this company's around for the next 10 years.
Yeah, I mean,
it sounds real simple when you put it on like that.
And it sadly is simple, and it's why most people won't do it, because they want to overthink everything.
Well, that's what I'm talking about. That's why you want to go to Edgewater Family Wealth, because they're not overthinking it. They're not making these wild speculations and doing all this kind of stuff. They're looking at the numbers. They're doing it with a proven track record. Scott, how long have you been doing this?
36 long years.
36 long years consecutively.
We were doing it all on paperback. We were grinding it into cave walls. The ticker symbols were in the cave walls when I started doing it.
Yeah, the real downside is there's no more ticker tape parades anymore. That's the only thing.
No, that does suck.
But check out Edgewater Family Wealth. EdgewaterFamilyWealth.com is that website. You can get links to past shows, financial talks, and the contact information for them as well. I know people that use Scott, and they are incredibly happy with the work. Ecstatic with the work that him and Tammy do. And Tammy's doing that hard work for you with the numbers. You hear it every week. So EdgewaterFamilyWealth.com, and we'll see you next time here on your radio.
Yeah, and clearly people are rich, right? Or wealthy. You don't have to be rich. I like the term wealthy better. I mean, to rich reminds me of like the Monopoly guy or something. But, you know, there are people, there are regular people.
Now that guy I trust. You
Yeah,
don't see the
no.
problem, Scott. You don't have a monocle.
Monocle is, now, if you can meet a guy with a monocle, I mean, like, I'm all in.
What was his financial advice? He said buy Park Place?
Where is that?
Where is that? I can't find it.
Tune in to It's Only Money with Scott Brown from Edgewater Family Wealth, Sunday mornings at 7 on Real Radio 104.1. Raymond James Financial Services, Inc., member FINRA SIPC. Edgewater Family Wealth is not a broker-dealer, is independent of RJFS.